what I would also see is some of the Indian startups becoming global. All this while, what you had was global startups or global ideas coming into India. The Indian ideas not really pushing into the global world. But the way Indian economy has been built, or way some of the Indian startups have been built frugally, you will see some of those export of ideas. You're already seeing that with UPI, and completely Indian idea going global and getting adopted globally.
Hey guys, Mohit here. In today's episode, we'll be learning some, key secrets about, funding investments fundamentals, right? What investors to look, before they would want to invest. What are the red flags and many other interesting, insights, right from a veteran who has been there in the industry for last 2 decades, right? Keep watching, keep listening, and keep hustling. Thank you. Hey guys, very good morning. Today, I have a very esteemed guest, Mandar Mhatre. Mandar doesn't need an introduction. He's been heading Epic Partners, who's been a pioneer in investment and various other verticals for the last 2 decades. I'm your host, Mohit here. You are watching a new episode in Blash E-commerce Growth Academy. So welcome, Mandar. Heartily welcome from the entire team of Blash.
Thank you, Mohit. Pleasure to be here.
Lovely. So, it's good to start with a little bit of your background, Mandar, a story behind it, what you have been doing so far.
Right. So, Mohit, I've been career banker. Started with equity research, then went into corporate finance, and then into corporate strategy. Uh, After that, started a whole bunch of companies, ran a firm called Apex Group for India, grew it from 80 odd folks to about 2,500 folks over a period of 3 years. And now I run Epic Investment Partners, the India business part of it.
Okay. So, let's start with a very, very basic fundamental thought right now. We all know that, the whole landscape around investments is changing as we talk also, right? The
Yeah.
way, the consumer brands or anyone who was raising investment 5 years back, probably things have changed a lot, right, today. So, what is your thought, Mandar? What's happening in the industry?
So few drivers or few fundamental drivers which have changed clearly, right? And then let's take few steps back. First of all, if you look from an Indian demographic perspective, that story still kind of stays intact. What you are going to see is a massive uptake, not just in the population, but in terms of conspicuous consumption, which is going to be there. That penetration, which historically you've seen in top tier cities, is now moving down to tier 2, tier 3, and even to the some of the rural areas. So those fundamentals remain very, very strong, and they will continue to grow over a period of time. Secondly, people moving away from unorganized to organized. Suddenly, you find a whole bunch of folks who do not want to use unbranded stuff, even if it is at the lowest end of the brand. That brand is going to entice interest within people. And thirdly, the access to the market, which hitherto was very difficult, and the engagement around that market is becoming increasingly interesting and increasingly easier, specifically because of digital commerce and the kind of content strategies which most of the D2C players are using, right? So those fundamentals still remain within the market. What's changing is increased focus in terms of the right target customer segment. The approach which was there maybe about 3, 4, 5 years back, where funding was very easy, was to raise a large round, carpet bomb pretty much everything, and figure out who is our consumer and how do we target that consumer segment, needs to definitely change. No longer do you have the luxury of raising a very, very large round at the initial stage, which simply means that you need to come in with a very good value proposition in terms of who that target segment is, what are the key metrics which you are following around those target segment, and then raise accordingly and expand in stages, right? So, in my mind, if you kind of break it into two parts, the business fundamentals still remain. The valuation or the liquidity funding fundamentals have clearly changed, and they will remain muted for foreseeable future. unless something globally changes at macro level. Now, with that in your mind, you now need to start thinking about how do you build a business with these drivers and these constraints in place.
Okay, okay. So you touched upon, areas, probably, where, the focus has shifted, right? So if I have to ask probably a hot question here, that what are the sectors which, Mandar is taking bet on?
Interesting. So, a couple of things. I'll divide it into early stage and late stage. That if you have to look at early stage, what you're effectively taking bet on is the team and is reasonably sized market.
Okay.
Right? You need that team to kind of very clearly articulate what their vision is, what have they done in past, how is that experience going to help them. You also need that team to articulate a path in terms of what they want to achieve over next 18 to 24 months, and also finally you want to see some early results, very early results into that. Yeah. Now, an approach like that, when you're looking at the team, you need to be really sector agnostic. You won't get into sectors where your insights are fairly limited, so you will tend to avoid those sectors. From my perspective, I typically look at fintech, I look at consumer, I look at medtech, I look at edtech. These are sectors which generally have fundamentals which do not change overnight, and we generally will have a structured way of building businesses, right? These are not your classic 0 to 100 segments or 1 to 100 segments. These are classic 1 to 10 segments, but if they are well executed, they can build you good. Second question, and the second part of it is, what would you look at when it is late stage? And at late stage, what you're effectively looking at is that all of your early risk of the business are taken out, and you've got a structure in place which allows you to now scale by adding capital.
Okay.
This typically again are into businesses which are doing well. So if I have to take a look at, let's say, consumer as an example, and if I have to look at consumer in the early stage, what I would be looking at is effectively, was the team is there, the product at least is there, there is decent bit of branding, and there is reasonable bit of understanding of kind of customer segment you are looking to kind of build into. If you move slightly ahead in terms of stages of that business, what you would want is that they've at least cracked one or two markets fairly well and are doing reasonably well into that, right? If you now take that a bit more further, what you're now effectively looking is maybe in the middle stages. What you're now looking at is effectively product expansion from one or two products into multi products. You're looking at distribution expansion, you're looking at team expansion. And if you have to take that into the later stage, is then really about how do you build all of that scale far more efficiently. Where are your unit economics going to look like? How do you build it? How do you not build it, right? And that also presents couple of interesting opportunities. You will find companies which are well sorted, and all they need is bit of capital to grow very quickly. And you would find companies which are in interesting areas. They show early signs of successes, they show indicators which mean that their businesses could do well. However, they are not the most efficient businesses in the way they have been structured and built. And there, what you want to do is look at that inefficiency and take a call on whether that inefficiencies can be done away with, and over a period of time build that business, right? So the principles of what you're looking at apply across all the four segments which we are looking at, right? It's just at where you're coming from, what you're doing, and at the end of the day, at what valuation you're coming in at, right? Because you may still find a good business, but if that business is asking you for a very unreasonable valuation, it simply does not work.
Okay. Okay. So I'll probably break this thing down into a little simpler terms for, many of the founders, who would want to raise money, right? And would be, the listeners of this podcast series, right? So what would be some basic parameters, when you will look, for the early stages stuff, in terms of, hey, this looks to be, the fundamental aspect, right? How do you
Yeah.
categorize that? Top two
Uh,
things?
So if I'm looking at, let's say, early stage, and if you're talking early, I'm not looking at anything beyond pre-series or beyond pre-series A, right? That to my mind is a bit early stage. What I would obviously look at is who the founders are, what the team is, what kind of plan they have put in place, right? What I would also look at is, do they have a product which has some legs into it, right? Is that product something which is getting loved by their consumer? The value, the number of sales which you're doing, it really depends on whether it's a B2C, whether it's a B2B, or whether it's something else, right? So whether that product is getting loved, not loved, whether the founders are thinking in terms of iterating and in terms of looking to build that, and how that team is structured. These are some of the key indicators which I would look at. When I look at founders, right? I would also look at whether they have taken care of co-founding agreements, whether the legal entity structures are correct, whether they've got some basic MIS in place, and they understand what that MIS is, and whether their target markets are giving them the expected results. Right? So these are very, very basic things which we would basically look at. And then when it comes to funding of an entity like this, what is expected is to have a very clear understanding of why these funds are getting raised. What's the purpose of raising that fund? What do you want to achieve out of those funds? What happens when you achieve those things? What are your timelines around it? What happens when you achieve those things? Are you looking at larger rounds? Are you looking at exits? Are you looking at something else while you look at, and what are those numbers when you're looking at that, right? So having that vision while you may be raising that round for your immediate 12 to 18 months need, but while raising that, having that initial vision of how this business could potentially pan up over a period of 3 to 5 years is going to be important. It may not exactly pan up the way you think about it as of today, and you may change, but it's important to clearly articulate that, or at least clearly display that you're thinking about this business over a long period of time, and this is how you're thinking about it.
Okay. So this has a supplementary thought, right? So now, what are the red flags that you notice that, hey, maybe these are not the areas, or not the right time or the opportunity, right? That also could be a good feedback for many, to correct and probably change.
Absolutely. Feedbacks are multiple. Frankly, the first red flag comes from the body language of founders. So when you meet personally and you ask them those hard questions, the body language clearly gives away some hints, and you can very quickly notice whether people are lying to you, whether they've thought through certain things, whether they've not thought through certain things, whether they're focused on their conversations, whether they're fidgety, not fidgety. Right? So these are some of these most important feedback points which come in. Secondly, when you basically meet some of these founders, what you will find is two or three types of founders. There are founders uh, who would upfront ignore pretty much every single bit of conversation which happens. They are wrapped up in their own mind in terms of what and how they want to build up, and they just basically tend to ignore whatever is spoken in that conversation, and they tend to focus on what they want to say. That good founders I've typically seen, they listen to everything. They also typically will follow up with an email saying, look, these are the things which we spoke of. I agree with points A, B, C, D, and this is what we are looking to do, and I do not agree at point B, B to F, and simply because that's not my priority, or this is a market which we've looked in past, and this is what we believe, right? So what you would see is, second attribute is that most good founders are good listeners. They listen to what's been spoken in that conversation, and they revert back fairly quickly within literally 24 hours in terms of what that conversation was, right? Secondly, what you would also see is parameters around your businesses, right? When you start asking questions around financials, and when founders are not on top of their numbers, they can't tell you how many units have been sold, they can't give you the split of those units, they can't tell you what are your attributes of the customers, right? Those are the kind of businesses where even if the numbers are good, you would want to avoid. These are the businesses where founders simply do not have handle over what's happening in their business, right? And thirdly is in terms of the vision. How do they want to kind of take it to the next level? What do they want to do? Where do they see the next leg of growth coming in? Where do they see the next level of your hiring coming in? How are they thinking of their teams? How are they thinking of the structure to build their businesses? Those are three big parameters which are there, right? And what you would also notice is the evaluation literally starts way before the meetings happen, right?
Correct.
Any good investor will tell you that they get inundated with thousands of email from started founders, either even via introductions. The challenge for a founder, challenge for an investor is to spend ample time with the ideas which are meaningful and reduce the amount of time on businesses or ideas which do not make sense. Right.
Correct.
So it's for an investor, it's a process of elimination first, even before you start the selection process. And how do you then start? The bigger question is how do you eliminate some of those things which come to your table? That's where trick are, and many people have various ways of eliminating. They'll tell you that look, these are the sectors which we look at or which we don't look at. This is the size of the deal which we look at, which we don't look at. Many people will also interestingly not respond to the first two or three emails which are sent by the founders, irrespective of how good or bad that idea is, right? The idea here is that they just want to see whether you're persistent enough in chasing someone. Many people will give you odd times of meeting, odd hours of meeting, so that they want to just check whether there is enough motivation for you to do those meetings at those odd hours, right? So these are ways to essentially eliminate founders or eliminate ideas or businesses which may not meet some of the basic tenability or tenacity criteria which you would have out of entrepreneurs.
I think very interesting insights, Mandar. So, a lot has been talked about these days about, unit economics and profitability, right? Like, it's
Right.
been one of the imperative vertical to, look forward to. So, what sort of frameworks probably, founders at any level, right, should attack, right? So generally founders, I have seen at least in the articles, and I run a business. So, so now where the focus on the unit economics has become very, very important, right? So what is your thought or probably your guideline, to walk on this path?
See, it again depends on business to business. In, let's say, a completely software type of a business or a SaaS type of a business, achieving unit economics quicker is far easier than, let's say, in a consumer business, right? Because in consumer business, while there is a direct cost of your product, the units, the economies of scale only set in after a certain volume is achieved. That's number one. Number two, there is distribution cost involved in that business. And number three, there is a whole bunch of marketing branding cost which is involved in a business. So if you look at any classic distribution business or any classic consumer business, you typically not see a break even before they hit about $80 million in revenue. Right? Now that's a very large number if you're looking at a consumer business, but that is the nature of the business. You very rarely see a business hit profitability at an operating level before they hit that number, and it's possible. I'm not saying it's not doable, but it's possible. Those are the type of, if somebody does that, those are the type of businesses which will pick a lot of investor interest very, very quickly. Right? Whereas if you look at SaaS type of business, you would probably look at that number at close to maybe even $3-4 million. Right? So that white mode is massive. At one end, you're looking at 50 million type of revenue business when it comes to playing unit economics. And which is why what you would also see is increasingly there is a lot of, or historically, there has been a lot of interest in SaaS type of businesses because they not only are unit economics profitable fairly early at the stage, but they are also massively scalable if you get the business model right. Whereas consumer businesses are slow burns. There is a lot of physical effort which you need to put in, even if it is digital, even if it is D2C. There is a lot of physical effort which you need to put in. There is a lot of strategizing which you need to do, a lot of hypothesizing which you need to do, right, to build that business. And even after doing that, there's nothing which stops large competitor to come in and very quickly replicate your strategies. And so much harder in terms of scale, and in terms of figuring out who could be potentially successful candidates in there. What you will also interestingly see is that there is generally a lot of noise when it comes to consumer business. So you'll see their founders fairly often on social media. They are running their own podcasts, they're attending events, they're speaking, right? Whereas, on the other side, you have SaaS founders who are very quiet. If you have to count the number of SaaS founders who are there in public domain, you'll probably not cross more than 10 or 12 of those guys. And those 10 or 12 guys will be really, really successful. They're already sitting at $1 billion enterprise. But if you have to count the number of D2C founders, and you have to count how many of those have not even crossed 20 million in the revenue, that number itself will be in excess of a couple of dozen, if not more.
Correct. Correct. I mean, sometimes it actually hits us back as a SaaS founder that, hey, are you doing the right thing? Are you, because everybody else is talking in the market, and you are, you don't have, that kind of a PR to talk a lot, right?
Yeah, so it's a paradigm between rich and famous.
Correct. You touched upon, the global stage here, right? We all know that, the startup ecosystem in India is becoming transformational. But you have been, watching the sector, very closely for last 20 years, right? So how do you see, very closely the insights around that? Where do you see India ecosystem in the global stage, Mandar?
So, in my mind, India is still scratching its surface. We've still not gone deep enough. You know, at least what has happened over 20 years is that the awareness and the support ecosystem has substantially improved. So you take scenario 20 years back, it's not as if India didn't have startup. There were startups in India, but nobody really thought about those startups as startups. They always thought, okay, if you have to start a business, let's build a cash flow business, right? Nobody thought that there could be a game like valuation game which comes into play. Some of the early guys who got into those startups were the guys who came with global experience or had worked with global firms even though they were in India. So they've seen internally how these things work, right? the the real flip to this ecosystem started only happening around 2010, 2012, when some of these angel networks started to push it, as well as some of the initial startups started to get meaningful funding. That's when people started to take notice of it, and then eventually, the pink press started to notice some of these startups. Now, what you've got is at least two generations of entrepreneurs who built two, three companies, who come back into the ecosystem, are happy to support a whole bunch of players. Right? So there is a lot of advice which is available in the market today, which was not available, let's say, 10, 15 years back. A lot of the startups which failed 10, 15 years back failed due to lack of that advice, due to somebody telling them, please don't go down that path because that path is going to lead you to doom. That advice simply did not exist. Today, that advice exists. What's not happening today is that euphoria. Anybody who starts startup starts to believe that they've got the next unicorn in their plate. They are fairly aggressive when it comes to raising funding. They are very fairly aggressive when it comes to looking to build business, right? But what they fail to realize is that sometimes startup journey is not that linear. It's not that straightforward, and it's never very quick. You can literally count number of startups on your finger which has done really well within the first 2 years of operations. Right? Usually, good startups take anywhere between 5 to 8 years to build, and then from there to scale it into meaningful numbers. That's the kind of effort which is required.
Okay. So having said all these things, right? So where do you see, India again in the global stage? Probably, agar we push the clock by 10 years, right? What is
Yeah.
your hunch here?
I think India will continue to see growth, and from both areas. Right. First is the Indian macro is fairly dynamic. What you're seeing is that $1 trillion getting added every 2 to 3 years, which is massive in itself. Right? there across sectors. So you are going to see Uber regional startups which will come up. You are going to see startups with some of the global ideas coming into India, right? So those all you will continue to see from an Indian perspective. What
I think it was truly insightful, Mandar. For me also, I learned many things, right? So, I think truly thankful from the entire team. One last bit of section, which I like it personally. So, if you have to quickly summarize for, founders on a general, like, what are the 2, 3 frameworks to build a sustainable business, Mandar, in a very short and simple terms?
Yeah. So as you start to think of business, right, remember that every business will have X number of risks. Usually, when you start a business, you will have 15 to 20 different type of risk, which is there, right? It's right from your idea to MVP, to your founders, to your early investors, to even legal entities and the structure and the governance mechanism which you put in, right? Some of these risks are very easy to take off. So take those out of your equation very early into the process, right? So for example, if you look at idea, ensure that you've done enough work around validating those ideas. So do that research, do that effort, unless you come from an industry and you already have those deep insights in the market, right? Even if you have deep insight, I would suggest spend 15-20 days of serious research, both desk as well as speaking to your clients before you launch, right? And that will save you a lot of pain as you look to go ahead. Secondly, if you are taking founders, ensure that you've got the right co-founder agreements in place. The last thing which you want to do is start work with 2 or 3 of those guys. Couple of them after 12 months say that, hey, look, we don't want to do anything. My financial position is challenging and I need to get back to job, and that's okay. But what you don't want is that founder still holding 30% of the company, right? And as you start to build businesses, you suddenly realize that you are the one who put in that effort, and that guy who just put in initial whatever it is still holds large majority or large stake in your firm, right? So you have to take care of those type of things. And governance and MIS, it has to be built right when you're small. It is incredibly hard to build that, incredibly hard to ensure some of those things as your business grows, right? It becomes much more complicated, it becomes much more time consuming, right? So ensure that you are building some of these things right early in the stage. And finally, ensure that you have the right set of advisors into place, right? What you want is advisors who come in with specific domain expertise or domain knowledge, right? So when you are looking at advisor, very clearly define what type of advice are you searching for. Is it marketing advice? Is it legal advice? Is it finance advice? Is it your industry specific advice? And then identify a list of advisors who could potentially play a very good role at it. Very clearly articulate to them that this is why we need you, this is how the compensation will play out, these are your deliverables, and then sign up those advisors. Don't jump onto the first guy you get and say that, look, because you got title, please become my advisor. It doesn't help you, and a lot of startups struggle with that, because early on you end up giving 8-10% equity to all this bunch of advisors and they don't add value. It becomes very, very difficult at later stages, right? So these are some of the basics which you need to take care of when you're looking to build early on into your business. My advice, Mohit, would be very different if you come to me, let's say at series A, and my advice will be very different if you come to me at, let's say, series E, series D type of businesses, right? There the complexity of challenges,
Correct.
the nature of beast is very different than what you have at seed level. And lastly, as a founder, your objective and your job is to optimize the wealth for you. So sometimes if that means that you have to find somebody better than you as the CEO, so be it. Take that back seat. Don't let your ego play into your business.
Correct. Very insightful again, Mandar. I think truly enriching conversation, Mandar. I truly thank you from the entire team here, right? I think community will enjoy, and from your deep insights around the topics.
Pleasure, Mohit. Thank you so much.
Sure.
And have a lovely day.